Good afternoon, ladies and gentlemen. You're very welcome to this lecture. In today's lecture, we're going to look at the principles of corporate finance. As already alluded to, today we are looking at the principles of corporate finance. These principles are three. That is the investment principle, the financing principle, and the dividend principle. The investment principle. This is stated as the rate of return yielded by projects or assets invested in should be greater than the minimum hurdle rate. And this principle determines where businesses invest their resources. So the implication here is every time you're investing in a project, the yield that you're going to get, that is the rate of return, should be greater than the minimum hurdle rate. So it's not just a question of investing, but you have to look at the return that you're going to get at the end of the day. Is it greater than the minimum expected return? Or is it less? If it's less than the minimum return expected by the investor, then you don't need to invest in that particular project. But if it is greater than that, then that is a sign that you have to go ahead with the project. We may be wondering what the hurdle rate is. The hurdle rate is the minimum rate of return on a project or investment that is required by an investor. This hurdle rate describes the appropriate level of compensation for a particular level of risk that is present. In other words, what this means is that it looks at the risk to which an investor is exposed to. If the risk that an investor is exposed to is high, then the hurdle rate tends to be higher. If the risk is low, it tends to be lower. That is, high-risk projects attract a higher hurdle rate, and those that are lower-risk projects attract a lower hurdle rate. In addition to the level of risk or the exposure to risk, this rate also incorporates or takes into account the return on the projects, the cash flows, and the timing of the same cash flows. So it will look at the return that you're going to get on a particular project once it becomes operational. And then how are the cash flows going to be? That is, how much are you going to be getting and how much are you going to be spending? And also the timing. So if you look at these three factors, they are bordering on the value of money, the time value of money. So you look at issues like what's the present value like, or what's the future value, okay? And then those are going to be more like a guide to determine as to whether it's appropriate or it's okay for you to invest in a particular project. Let's look at the financing principle. The financing principle states that you need to choose a financing mix that maximizes the value of the investments made. So here you're looking at the financing mix. What mix of financing are you going to use? Are you going to use mostly debt or mostly equity? Is it long term or is it short term? So those are the things that you're looking at. Then you need to match the financing to the nature of the assets being financed. Of course, there are those assets that are capital in nature, the fixed assets. We call them capital assets. So those assets demand that you go for a financing mix that it might be debt, but then the rate of return has to be quite low. Or it may be equity. Now that depends on the availability of the finances. Do you have enough earnings that you can use to finance this particular project? Or do you have people who are willing to fund this particular project? That is, you're looking at the shareholders. Can you sell the shares so that you raise the money to do that? Or do you have to borrow the money? But even as you do that, there are so many factors that you need to look at, like the interest rate, the timing, or when are you supposed, or when are you expected to finish paying off that particular debt or loan? So the financing principle is what governs the mix of funding used to fund investments. There's also the dividend principle. Even as the name suggests, dividends are all about what the shareholders or what the owners of the business get at the end of the day from the earnings that a particular undertaking makes. The profits that are made are divided among the owners of the business. They are shared. But of course, it's not all the time that this has to be done. So you're looking at how is the policy going to be like? How are we going to be sharing the proceeds from the investments? So essentially, that is what the dividend principle looks at. I hope we've enjoyed this lecture. And if you found this lecture to be interesting, or if I've in any way added value to what you know, then I would urge you to subscribe to this channel. Thank you so much.